Can you hear me?
Yes, sir.
Right. So we were discussing on accounting analysis. Under the accounting analysis, we were doing analysis of investing activities. So we completed inventory and cash in hand, cash and equivalent. Right. So today we are going to do this, complete this lesson. After that, we'll be doing a tutorial. You can find the tutorial from the LMS. Right. So when it comes to receivable, types of receivables. So trade receivables, receivables from related parties, tax refunds due, advances given to third parties, loans given to employees. So all are receivables. So usually these receivables are valued at transaction price. You know trade receivables. When you sell goods on credit, the receivables are valued at selling price. The receivable balance is calculated based on the selling price. When you sell goods to related parties, then it's valued at invoice. Right. So usually receivables are initially valued at or initially measured at transaction price. Then you have to assess the collection risk. Collection risk. You know, there are receivables, the recoverability is doubtful. For example, some of your customers may not pay you money. Some customers of your business may have become bankrupt. Then you can't recover those money from your customers. You can't recover the balances due from these customers. So receivables are initially valued at transaction price. If it is sale of goods or provision of service, then the receivable is valued at invoice price. Invoice price. So initial measurement is at invoice price. Then after initial measurement, so you have to assess collection risk. Then for the collection risk, you have to make a provision for doubtful debts. After assessing the collection risk, you have to make a provision for doubtful debts. Provision for doubtful debts. Then what comes to your statement of financial position is the total receivable amount minus provision for doubtful debts. The total receivable amount minus provision for doubtful debts. So the net amount goes to the statement of financial position. Now, as an analyst, what you do is you see whether the provision made in the financial statements is adequate enough. Is adequate. So you have to focus this item. So in the accounting analysis, you have to see whether this provision is enough. This provision is enough. So this is your key consideration. Because there are situations, company may not have made enough provision. You know, provision goes to the profit and loss account. Higher the provision, you get lower profit. So 1 minute, please. My connection is unstable. So I need to adjust, right? So give me 1 minute. Can you hear me now? Can you hear me?
Yes, sir.
Yes,
Right.
sir.
Now, so what you have to do is, so you have to look at the provision. You have to see whether provision is enough. Provision is enough. Because the company can manipulate the provision and make a higher profit. You know, lower the provision for doubtful debt, the profit goes up. So when you analyze receivables, you have to see company has made adequate provision for receivables, uncollectible receivables. Right. So let's see an example. So you come to this example. Right. Now you have information from the financial statements of accounting records of ABC Limited for the year ended 31st March 2021. In addition, you have competitors information. So your company is ABC, and these two companies are competitors. These two companies are competitors. Now you see sales, receivables at the end, then provision for doubtful debts. So all values are given in millions. Then you see A Limited sells goods on credit and gives the customers a credit period of 30 days for settlement. Now you see one of your competitors sells goods on credit. So that company gives 30 days for settlement. Then you see during the year ended 31st March 2020, last year. The current year is ending 31st March 2021. You see current year ending 31st March 2001, 31st March 2021. So here last year, during the year ended 31st March 2020, the revenue of ABC was 15 million. Receivables at the year end, 2.3 million. 2.3 million. Then you have, now this is very important. This is very important. This is called age analysis of receivables. You can write down. This is age analysis. Age analysis of receivables. Age analysis of receivables of your company. So this is given in thousands. This is given in thousands. So this kind of statement usually generated by the company's accounting system. At any point in time, at any time, you can have this analysis from your accounting system. Right. Now you see, you have three customers. You see, you have three customers. How much total outstanding balances of your customers? You get the total of these. Total outstanding balance. $5,440. In thousands, 5,440. In millions, 5.44 million. Right. 5.44 million. Sorry, total outstanding balance given. 2 point is given here. You have only 2 customers. Sorry, you have 2 customers. Total outstanding balance is given here. 2,720,000. 2,720 in millions, 2.72 million. 2.72 million. Now you see your outstanding balance, 2.72 million. Now you see the receivable balance includes 2 customers. Receivables balance includes 2 customers. You see balances are due more than 6 months. You see balances are due over more than 6 months. So if you look at XYZ, out of 1050 balance, 550 due over 12 months. And balance 500 due over 18 months. So this customer has not been paying the company over 12 months. Then next customer, PQ Limited, out of 1670 balance, 670 due 6 to 12 months, and balance 1000 is due 12 to 18 months. Now you see the balances seems long outstanding balances. So these 2 customers balances seem long outstanding balances. You see out of total balance, you see the total balance. So out of this total balance, 500 due over 12 months, 1550 due 12 to 18 months, and 670 is due 6 to 12 months. You see a major part of this balance has been outstanding over 12 months. Now what's your observation is the receivable balances are or receivable balances seem to be long outstanding balances. So this is your observation. These are long outstanding balances. These are long outstanding balances. These balances are unpaid over a long time period. So when this happens, the collectibility is more doubtful, more uncertain. So longer the balance is outstanding or longer the balance is unpaid, the collection risk is higher. Then you have to make a higher provision, larger provision. Now you see what your observation is, the receivable balances, major part of receivable balances are outstanding over 12 months. You see, these balances are outstanding over 12 months. You see, these balances are outstanding over 12 months. You see, major part of receivable balances are outstanding over 12 months. So it's a long time period. You see, usually company gives only 30 days credit. So if you look at even competitors, you see competitors give only 30 days credit. Only 30 days credit. But your balance is outstanding over a long time period. Right. Now your question is examine the adequacy of provision for doubtful debts. Examine the adequacy of provision for doubtful debts. So you have to examine whether provision is adequate in the account. You have to analyze and see whether provision is adequate in the account. Right. So this is how you analyze. This is how you analyze. So you can calculate receivables as a percentage of sales and compare with competitors. You can calculate receivables as a percentage of sales and compare that percentage with competitors. In addition, you can see a trend in the collection period. You can compare the average collection period with the credit period given to customers. Then you can see the age analysis. And see whether there are long outstanding receivables. Long outstanding receivables. Right, now we'll do a simple analysis. So your company is ABC. Now you see your company's receivable percentage. So your company's sales in million, 16 million. Receivables at the end. Receivables at the end, 2.72 million. Then percentage of receivables. Receivables as a percentage of sales. Receivables as a percentage of sales. $2.72 divided by 60. It's 17%. 17%. So you can compare with competitors. Competitors are ANX. ANX. Sales 20 million, receivables 2 million. Percentage 10%. X receivables 15 million. Sorry, sales 15 million, receivables 1.8 million. Percentage 12%. Now you see, your company receivables are large. So your company has higher level of receivables compared to competitors. So your company has higher level of receivables compared to competitors. So that the provision for doubtful debt in your accounts should be higher than those of competitors. Because usually higher the receivables, the provision should be large. Higher the receivable, larger is the provision. In addition, you can calculate a receivables collection period. You can calculate receivables collection period. Companies A, B, C, A and X. So calculate receivables collection period. Receivables collection period. How many days? You know how to calculate. Debtors collection period. Now calculate how many days. How many days of collection period for these three companies? So on average, 62 days. For ABC, then APLC, $37 days, XPLC, APLC 37 days, XPLC 44 days. So you can compare this collection period with credit period given to customer. So you can compare with Credit period given to customers. Credit period usually 30 days. According to the question, 30 days. Now you see, your company collection period above the credit period. Your company's collection period is well above the credit period. So this is another indication that you have a higher collection risk. So this is another indication your company has a higher collection risk compared to competitors. You see your company has higher collection risk. Your risk collection period is higher than competitors. So your company has higher collection risk compared to competitors. In addition, you can see the age analysis. Now you see age analysis. Age analysis. You see the age analysis. You see a larger part of balances are outstanding over 12 months. So this is another observation. Larger part of balances are outstanding over 12 months. Outstanding over 12 months. Right. Now you see all these indicate collection risk of your company is higher than those of competitors. Collection risk of your company is higher than that of the competitors. Then your company should make a large provision, especially by looking at these long outstanding balances. So when the balances are outstanding over 12 months, so recoverability is more uncertain, completely doubtful. You see many balances are outstanding over 12 months. You give customers only 30 days credit. You see these two customers have not paid many balances over 12 months. Right. So it can be the situation that you cannot collect these balances. But if you look at the provision, you see company has made provision for doubtful debts. Only 0.136 million. It's only 136,000. In thousands, 136. So the provision made in the accounts in thousands, 136. But you see, 1,550 balance outstanding over 12 months and another 500 balance outstanding over 18 months. So these two balances are completely unrecoverable. That can be the situation. These two balances are completely unrecoverable. The company cannot recover these two balances. Company may have taken legal actions. So if you are an internal analyst, you can discuss with the company lawyers and see whether the company has taken legal actions to recover these balances. Right. So by doing that, you can see whether this provision is adequate. Now, according to your analysis, you find this is not enough because company has higher collection risks and many balances are outstanding over 12 months. Then there should be a larger provision in the accounts. There should be a larger provision in the accounts. Right. So likewise, you have to analyze. So when you analyze the receivable, you have to see whether the provision is enough. The provision is enough in the account. Right. So in the analysis of receivables, you have to focus on provision for doubtful debts. You have to focus on provision for doubtful debts. Right. Now let's see the last part of the lesson. We have done analysis of 3 current assets. Then we'll move on to non-current assets. Non-current assets. So I asked you to read these accounting standards. So you should have read before. Right. So you have the idea. You have the idea. So here we look at property, plant and equipment. Under analysis of non-current asset, we'll see property, plant and equipment. So you can follow two measurement bases. To find the carrying value of property, plant and equipment. So one is cost model. The other one is revaluation model. Revaluation model. So in these two models, so you are doing capitalization, then allocating the cost of the asset capitalized, amount of the asset capitalized. So we call it depreciation. Depreciation. So in both model, you capitalize the value of the asset. In the cost model, you capitalize cost of the asset. In the revaluation model, the revalued amount is going, you take the revalued amount into the accounts. Then amount of the asset capitalized is allocated over the useful life. So we call it depreciation. We call it depreciation. Then there can be impairment. According to LKS 16, you have to find the indications of impairment. When there are indications of impairment, you have to estimate the recoverable amount of the asset. The standard says how to calculate the recoverable amount. Then accordingly, you have to adjust for the impairment. Now you'll have to see, company has followed this when accounting for property, plant and equipment. Company has follows LKS 16. LKS 16 when accounting for property, plant and equipment. Right. So you have the idea on LKS 16. You can read the company's accounting policies. And you can see the accounting adjustments in the notes. Then you can make sure company has followed LKS 16. LKS 16. Right. So that's the first thing you should do. So when you analyze property, plant and equipment, so you see whether the LKS 16 has been applied. So it says how to capitalize asset. It's give a relevant instructions or relevant guideline for depreciation and impairment of assets. So that's your first step. You see whether the company follows LKS 16. So you don't have access to accounting internal accounting system. For example, if you are an external analyst, you can't see the journal entries. You don't have access to the company's accounting system. So what you can do is you see the company's accounting policies. In the published financial statements, you can find the accounting policies. You see whether accounting policy for property, plant and equipment is in accordance with LKS 16. Then you can see the property, plant and equipment note and see whether allocation, depreciation, impairment adjustments have been done. Right. So you study the accounts and see whether company has applied LKS 16. In addition, you can calculate these ratios. You can calculate these ratios to make sure adequate depreciation impairment adjustments have been done in the account. Right. So you can calculate these ratios and make sure company has adequately depreciated and made adequate impairment adjustment in the accounts. Right. Now let's see a very simple example. So let's see an example. Now let's say company purchased a machinery on 1st April 2019. So you can write down this example. A machinery was purchased for a cost of rupees 10 million. Now let's say company's accounting policy. Company's depreciation accounting policy. Let's say depreciation policy says this machinery depreciated over 5 years. Machinery depreciated over 5 years. Right. So you can find this from the accounts. Now, if you look at, so I'll show a practical example. So let's see John Keel's annual report. This is annual report of John Keel's holding. You see in the financial statements under accounting policies, right? Now these are the financial statements. Then you can come to the notes to the financial statements. So in the notes, you can find accounting policies. So let's see the property, plant and equipment accounting policy. Right. So this is about property, plant and equipment. Now you see the accounting policy says the company's depreciation policy. Now you see for each asset class, you see the useful life. You see for each asset class, the useful life in years. Useful life in years. In addition, if you read these accounting policies, you can find, you see impairment, and you see the property, plant, and equipment values, revaluation, right? So there are a lot of things discussed in the accounting policy. So what you have to do is, you read the accounting policy, entire accounting policy, and see whether it's according to LKS 16. So you read the property, plant, and equipment policy and see whether it's according to LKS 16. Right. Now for the same you can apply in the selected company. You can see in a UK context, so UK companies are applying the country's own standard. So in the property, plant, and equipment standard of UK, you find similar guideline. Similar guideline. The guideline in UK property, plant, and equipment standard is similar to our LKS 16. Right. So you can see, you can read and see whether accounting standard has been applied. Right. Right. Now you see in our example, company depreciate machinery over 5 years. So depreciation policy says 5 years. Right. Now let's see property, plant, and equipment note. Property, plant, and equipment note for the year ended or 31st March 2021. Now let's see for this asset, property, plant, and equipment note for the year ended 31st March 2021. So you know how to prepare this note. You have studied under financial accounting. Fine. So one column is machinery. So company use cost model. So you have a beginning balance. Now machinery purchase in 2019. So we'll prepare the note in thousands. Note in thousands. So machinery cost at the beginning 10,000. So 10 million in thousands, 10,000. No additions, no disposals. Then costs at the end, 10,000. Cost at the end, 10,000. Then you can depreciate. So you can have depreciation. How much depreciation beginning balance? Machinery purchase on 1st April 2019. So beginning of the year is 1st April 2020. Then by the beginning of the year, machinery has depreciated 1 year. So how much 1 year's depreciation? Cost is 10 million. Depreciation over 5 years, 10 divided by 5. 1 year's depreciation is 2 million. So in the notes, you see a beginning depreciation 2 million. Depreciation for the year. Depreciation for the year 2 million. Let's say company follow straight line basis. Machinery depreciated over 5 years on straight line basis. Then during the year depreciation 2000, disposal 0. Then depreciation at the end 4000. Carrying value. Carrying value 6000. So this is what you can find from the accounts. Now, in addition to studying the accounting policies and see whether it's according to accounting standard, you can calculate certain ratios and see whether the depreciation is adequate. Depreciation is adequate. Now, if you look at these, property, plant and equipment note, you see by the end of the year, the carrying value of the asset is 6000. By the end of the year, carrying value of the asset is 6000. Annual depreciation is 2000. Annual depreciation is 2000. So remaining carrying value is 6000. The meaning is in the future years, 6000 has to be depreciated. So you see carrying amount 6000. The meaning is in the future, 6000 has to be depreciated. Annual depreciation 2000. Annual depreciation 2000. Then how many years you need to depreciate this asset in the future? The carrying value divided by annual depreciation. So number of years to be depreciated equal carrying value divided by annual depreciation. Annual depreciation. Carrying value 6000 divided by annual depreciation 2000. You see 3 years. 3 years. So this asset will be depreciated over the next 3 years. The meaning is the remaining useful life. Remaining useful life. So this asset has remaining useful life of 3 years. This asset has remaining useful life of 3 years. So you can estimate remaining useful life of property, plant and equipment by taking carrying value, then divided it by annual depreciation. Annual depreciation. So this asset has remaining 3 years of useful life. So this is an estimation. Then you estimate how many years this asset use. We call it average age. You estimate how many years this asset has been used. We call it average age. Average age. So you can see from accumulated depreciation. You can see this from accumulated depreciation. Now you see accumulated depreciation, how much? Beginning balance 2000. Depreciation for the year 4000. Then you see accumulated depreciation 4000. Beginning balance 2000, depreciation for the year 2000. Accumulated depreciation at the end 4000. So this asset has been depreciated by 4000. Total 4000. Annual depreciation 2000. Then number of years this asset use equal accumulated depreciation. Accumulated depreciation divided by annual depreciation. Annual depreciation. Accumulated depreciation 4000, annual depreciation 2000. So this asset has used, this asset has been used over 2 years. This asset has been used over 2 years. Now you see, this asset has been used over 2 years. Remaining lifetime is 3 years. Then how much estimated total lifetime? You have used 2 years by now. Remaining lifetime is, useful life is 3 years. Then the total useful life equal average age plus remaining useful life (2 years plus 3 years). The total useful life 5 years. Total useful life 5 years. Now, according to the financial statement, you can find by looking at the property, plant and equipment note, you can estimate this asset's total useful life, company's machinery's total useful life 5 years. So you can compare this, your estimated total useful life, with company's accounting policy. Now you see depreciation policy is machinery depreciated over 5 years. So from the profit, plant and equipment note, you got company's total machinery total useful life 5 years. So this is from the accounting adjustment. You see, by looking at the carrying value, by looking at the annual depreciation, by taking the accumulated depreciation, you found total useful life of machinery 5 years. Now, according to the accounting adjustments, the total useful life is 5 years. You can compare this with company's accounting policy, depreciation policy. Now you see company depreciate machinery over 5 years. So if you get a close answer, then you can, so you are more sure that company has made adequate depreciation on that asset. So in this example, you got the exact answer. You see useful life according to the accounting policy 5 years. Then by looking at the accounting adjustment, you got the same answer. So this is very simple example. Practically company has number of machinery purchased at different times. Practically you see company has many machineries purchased at different time, different years. Then if you apply this to a practical company or the published annual report, information from the published annual report, then you don't get the exact answer. But you can find whether the answer is very close one. Very close one. So if this calculation is close to the useful life mentioned in the accounting policy, then you can make sure company has adequately depreciated its property, plant and equipment. Right. So you can make sure company has adequately depreciated its property, plant and equipment. Right. Now this is how to analyze or how to do the accounting analysis of property, plant and equipment. The same method you can apply for intangible assets. You know, intangible assets are not depreciated, but intangible assets are amortized. Then you have to do impairment test for intangible assets. You see, so let's say John Kills Holding annual report. You see accounting policy for intangible assets. You see intangible assets. So you have to follow LKS 38. Now this is how intangible assets are amortized. Intangible assets are amortized over the useful life. You know, some intangible assets are acquired. Some intangible assets are internally generated. You know, goodwill is internally generated intangible asset, but you don't take into account except for consolidation purpose. But internally developed software, you have to bring into the account. So they are amortized over the useful life, and you have to do impairment test. Right. So you can follow a similar procedure the procedure similar to property, plant and equipment and see whether the company has provided adequate amortization and impairment for intangible assets. So in property, plant and equipment, we see whether company has adequately depreciated property, plant and equipment. Here you can see whether company has adequately amortized its intangible assets. So you can follow similar procedure. You can follow a similar procedure. First, you can see whether the accounting for intangible assets are in accordance with LKS 38. LKS 38. So you know this LKS 38, intangible assets. So you read the company's accounting policy for intangible assets and see whether it has been designed according to LKS 38. Then you see whether the company has followed its accounting policy. After that, you can calculate those ratios and see whether amortization of intangible assets is adequate. Right. So you can follow a procedure similar to property, plant and equipment. Then after doing the analysis, so you have to classify your assets into operating assets and financial assets. Because this classification is very important. So when you analyze in your operations, you look at only operating assets. When you analyze in your company's operations, you consider operating assets. Operating assets. The assets that are related to your operations. You look at only those assets that are related to your operations. So you may have investments, but those are not related to your operations. You may have investments in treasury bills, investments in treasury bonds. There may be situations these investments are not related to the company's operations. Then those assets you have to identify separately as financial assets. Assets that are not related to the operations, you need to categorize as financial assets. So here what comes under financial assets is assets that are not related to your operation. Example, investment in treasury bonds. If it is not part of your operations, it's a financial asset. Certain subsidiary investments sometimes are not related to your operation. Now let's say your main business is trading, buying and selling. Let's say manufacturing. Let's say you are running a garment factory. So your main business is manufacturing and exporting garments. But you have an investment in a company which is doing, let's say, hotel business. Now you see, your business is manufacturing and selling garments. But you have an investment in, let's say, a subsidiary that does hotel business, that carries out hotel business. Now you see, this investment is not related to your main business. Your operations are mainly manufacturing and exporting garments. But you have an investment in a subsidiary which does hotel business. Now you see, this operation is not related to your main operation. Then investment in that subsidiary, you can put under financial asset. Financial asset. Right. So you separate those assets that are not related to your main operations. You can put under the category of, you can say, non-operating assets. That's okay. Or financial assets. So instead of financial asset, you can use the term non-operating assets. You can use the term non-operating assets. The meaning is those assets that are not related to your business, main business. Then when you analyze in your company main operations, you look at only the operating assets. You look at only the operating assets. Right. So this is what you have to do at the end of the accounting analysis. At the end of the analysis of your assets, you have to separately identify which assets are related to your operations and which are not. Which are not. So when you analyze your operations, when you do a ratio analysis, for example, you consider only those operating assets. Right. Now we can do a tutorial. We can do a tutorial. So tutorial number 3. Right. So let's see question number 1. So you see question number 1. So I'll give 2-3 minutes. You have a look. Question number 1. So with this tutorial, you can find out so how this lesson is applied when you are analyzing financial statements. So remember, you have to do this accounting analysis before you start calculating any ratio for any analysis tool. Before you start applying any analysis tool for the financial analysis, you need to do the accounting analysis. So remember, accounting analysis comes first, then financial analysis. So you will realize now with this question, the way the accounting analysis should be applied even to the selected company. Right, now you see the situation given here. Now you see a Multiflower PLC's diversified company that is looking into acquire an engineering company. Now you see your company is going to be diversified to an engineering business. Now you see two companies, engineering companies, Black and Brown, are available for sale. Now you see you have two options. You can acquire Black or Brown company. So these are the two options you have. You can either go for Black or Brown. Right. Then you have financial statements of these two companies for the year ended 31st March 2021. Right. Now you see summarized financial statements. Statements of financial position. So here, printing mistake. Financial position. Right. Now what you do is, you have to compare these two companies and decide which company you should acquire. Now you are comparing these two companies. So before doing the analysis, so you can do a ratio analysis. You can do a ratio analysis. You can do common size analysis and select the company to acquire. You can decide which company to acquire. But before doing your financial analysis, you have to see whether these two companies' accounts are ready for the analysis. So that's what the objective of accounting analysis is. Before moving to the financial analysis, you are going to see whether these two companies' financial statements are suitable for the analysis. Right. And we have studied analysis of assets. we studied analysis of assets. Analysis of property, plant and equipment, inventory, receivables, cash. So with that, you are going to check whether these asset balances are suitable for the analysis. Now we are going to apply our learning to a practical situation. Now what we studied was analysis of assets, current assets and non-current assets. So with that analysis, you are going to see whether these assets balances are suitable for the analysis. These assets balances are at suitable values to start the analysis. Right. So if they are not suitable values, sometimes you find assets are overstated. Sometimes you find assets are understated. Then you have to do relevant adjustments. You have to do appropriate adjustments. So with this question, you are going to study all these. You are going to understand all these. So first we'll check whether the financial statement values are suitable for the analysis, especially asset values, because now we studied analysis of assets, accounting analysis of assets. So you see whether asset values are suitable for the analysis. If they are not, we'll do relevant adjustments and make them suitable for the analysis. So you're going to understand how this is done. You're going to understand with this question how these adjustments are done. Right. Now you see in the question some additional information. Now you see your purpose is compare these two companies and select the best. Select the company to acquire. So that's your analysis purpose. Right. Now you see additional information. You see additional information. Right. So I'll give 5 minutes. You look at all the additional information. Now you see number 1. You see a revenue of black includes 300 million goods sold to related party. On 15 March 2021. These goods have been invoiced at cost plus 20%. However, Black normally invoices goods at cost plus 50%. You see here, this company calculates selling price. The usual selling price is cost plus 50%. But when selling to a related party, so what the company charged was cost plus 20%. Usually this happens with related parties. So when company sells goods to related party, usually company charge lower price. Company charge a price lower than the market price. So usually that happens. Now you see, company has sold 300 million goods to a related party at cost plus 20%. So this 300 million is calculated on cost plus 20%. But company's usual selling price is cost plus 50%. Then you see, as at 31st March 2021, no cash has been received in respect of this sale. That means this 300 million has come to receivables. You see, this 300 million has not been settled by this related party by the end of the year. Therefore, this 300 million is included in receivables. This 300 million is included in receivables. Now you see, receivables of black company. Receivables of black company, trade receivables, you see 522 million. This includes 300 million price at cost plus 20%. You see again, this is very important. So your receivables includes, black company receivables includes 300 million valued at cost plus 20%. 300 million valued at cost plus 20%. Now you see a lower price. This 300 million, this sale is valued at lower price. This sale is valued at lower price. This is lower price. Now you see your trade debtors are not at the usual transaction price. Usual transaction price is cost plus 50%. But this receivables includes 300 million net cost plus 20%. You see, a part of the debtors are not at the usual transaction price. Part of the debtors are not at the usual transaction price. Therefore, you see debtors has been understated. Therefore, debtors understated. So this impacts your analysis. For example, when the debtors are understated, what happens? Turnover ratio overstated. Debtors turnover ratio overstated. So when the debtor value is understated, debtor turnover ratio overstated. Return on assets overstated. Return on assets overstated. Now you see this impacts your analysis. This impacts your analysis. You see, part of the debtors you have recorded, company has recorded at a lower price. Part of the debtors company has recorded at a lower price. Therefore, debtors have understated. So this impacts your analysis. This impacts your analysis. For example, when the debtors understated, debtors turnover ratio overstated. Return on assets overstated. Return on assets will overstate. Right. Now you see this impacts your analysis. So what you can do is, you can adjust the debtor value to bring all the sales into usual selling price. So you need to adjust the debtor's value to bring that balance into usual transaction price. Now, what is the usual transaction price? Cost plus 50%. So you can adjust this debtor balance. Then the entire debtor balance at the usual transaction price. Now, how much is that adjustment? You have to increase the debtor balance. You have to increase the debtor balance because this 300 is at a lower price. This 300 is at cost plus 20%. So you have to bring that to cost plus 50%. You have to bring that to cost plus 50%. So you have to increase the debtor balance. By how much? By how much? 300 is cost plus 20%. You have to increase to cost plus 50%. Then you see 300 is cost plus 20%. If the cost is 100, then 120, you have to bring that to 150. So 300 is cost plus 20%. If the cost is 100, then 120. 300 is now equivalent to 120. 300 divided by 120 multiplied by 150. How much? This transaction at the usual transaction price. The transaction at the usual transaction price is 300 divided by 120 multiplied by 150, 375. So if this transaction is recorded at the normal transaction price, the value should be 375. But the company has recorded at 300. Then how much adjustment? Company has recorded at 300. But if it is done at the usual price, 375, then the adjustment is 75. Adjustment is 75. So you have to increase the debtor value by 75. You have to increase the debtor value by 75. At the same time, you have to increase the sales. Because this 300 you have recorded in sales. Sales has also been understated. Then sales also increases by 75. Right. So we'll do that adjustment in the worksheet given. You can download the worksheet. Right. So I have uploaded with the tutorial Excel worksheet. So we'll see how adjustments are done in that worksheet. Right. Now you have the financial statements. So you can add two columns. We have two companies. So we have to do adjustments for both companies. Right. First, you can separate financial statements. Right. So from this, you can separate black financial statements from brown financial statements. Right. So you can prepare your worksheet. So this is for black. This is for black. So under black, you need additional two columns. Additional two columns. So one is values as given. One is values as given. Another column adjustments. Adjustments. Then values after adjustment or adjusted values. Adjusted values. Right. So you can have these three columns. Under brown, same three columns. Under brown. Now we are trying to make the financial statement suitable for the analysis. Right. So same structure you can apply to the statement of financial position. Same structure you can apply. Right. So you can copy these columns. values as given, then adjustments, then you have adjusted values. Right. So this is now the worksheet for the accounting analysis. Right. Now our first adjustment is 75. Black debtors increased by 75. Right. So debtors plus 75. Can say 75. This is plus 75. So debtors increased by 75. Then sales increased by 75. Sales increased by 75. So that's our first adjustment because debtors has been understated. Debtors has been understated. Right. Both debtors and sales have been understated because this company has sold goods to a related party at a lower price. So that impacts your analysis. Now you have brought the transaction to a normal price. So adjustment is 75. 75. Right. Now let's see additional information number 2. Number 2. You see number 2 about property, plant and equipment. So this is about property, plant and equipment. Now you see 2 companies, non-current assets. You see both companies, now 2 companies are black and brown. You see both companies have similar assets. Both have plant, property plant. You see both companies own very similar properties. Brown's property was revalued. Now you see Brown property at revaluation. Revalued to 2 million at the beginning of the current year. You see, at the beginning of the current year, Brown property revalued to 2 million. On this date, black property, which is carried out costless depreciation, now this is at cost. This is cost value. So black property valued at cost, costless depreciation. So company has followed cost model. Now you see black follows cost model. Black follows cost model. Brown follows revaluation model. Now you see 2 companies are following 2 different models for property, plant and equipment accounting. Now, can you compare two companies? Now, you see two companies' accounting policies are different. So when two companies' accounting policies are different, so you can't compare two financial statements because they are not on the same basis. Now you see black follows cost model for property, plant and equipment, but brown follows revaluation model. Now you see accounting policies are different, then you can't compare two companies' financial statements. Now you see you need adjustment. You need an adjustment here. Now let's see the other information given. On this date, black property had a book value of 1.2 million. Its fair value was also 2 million. Sorry, book value of 1,200 million. Its fair value also 2,000 million at that date. Right. Now two companies are having similar properties. Then fair value of the black property also 2,000 million at the time of the revaluation. Then you see both company had a remaining useful life of 20 years. Both properties had remaining useful life of 20 years from the beginning of the current financial year. Right. Now what you do is, you see black follows cost model, you bring that to revaluation model. You see black follows cost model, you bring that to revaluation model. Then you see both companies follows the same model. Then property, plant and equipment values are comparable. Now what are the accounting adjustments? Can you think about accounting adjustments? So black has currently recorded property, plant and equipment at cost model using cost model. Now what you do is you bring that to revaluation model. You bring that to revaluation model. Now you think about accounting adjustments. So you have to do the revaluation adjustment. You have studied in financial accounting. You know how to do the revaluation adjustment. So do the revaluation adjustment, then bring black property to revaluation model. You bring the black property to revaluation model. Now you see, so at that time, black property had a book value 1,200 million. You see, now we are going to adjust the black property. We are going to adjust the black property. Because brown property value is okay. Because that's at revaluation, which is better than the cost. Revaluation amount is better than the cost amount. So brown property value is okay. But black property at costless depreciation. Now you bring the revaluation here. You bring the revaluation model to black property. Now you see, So at that time, at the beginning of the year, the revaluation was at the beginning of the year. At that time, black property, book value 1.2 million, fair value 2000, book value 1200, fair value 2000. Then how much revaluation gain? How much revaluation gain? Book value 1200, fair value 2000, then revaluation gain 800. Revaluation gain 800. So what is the adjustment? Asset increased by 800. Asset increased by 800. Asset value increases by 800. And this 800 is revaluation gain. Revaluation gain. So this is the first time. This is the first time black property revalued, because earlier that was at cost model. This is the first time black property revalued. Therefore, that goes to the revaluation reserve. So revaluation reserve of black increases by 800. Currently, there is no revaluation reserve for black. So this revaluation gain comes to the revaluation reserve. Revaluation gain comes to the revaluation reserve. Right. Now we have brought the new value. We have brought the new value. We have brought the new value. Then you have to do the depreciation adjustment. How much remaining useful life? You see remaining useful life, 20 years. Then how much depreciation? How much depreciation? Let's see now. Now we have brought the new value, revalued amount, 2000. Then new depreciation equal revalued amount divided by remaining useful life, 20 years. Then new depreciation, 100. 100 is the new depreciation. How much depreciation you have already provided in the accounts? 100 is new depreciation. How much depreciation already charged to the profit? Depreciation already provided. Depreciation already provided. How much? How much depreciation already charged to the accounts? You can compare net book value at the beginning and end. Net book value of property at beginning of the year. You compare with net book value at the end. You see the question? At the beginning, you see a property net book value. You see beginning net book value, 1200. Beginning net book value, 1200. Net book value of the property at the end, 1140. Net book value of the property at the end, 1140. So beginning net book value 1200. Net book value at the end 1140. The difference is depreciation, because the question doesn't say any additions, any disposal. Then difference in the net book value is the depreciation for the year. So company has made depreciation of 60. Now you see depreciation already charged is 60, but new depreciation is 100. You see, new depreciation is 100. Then how much additional depreciation? You need additional depreciation 40. So after the revaluation, company should have charged 100 depreciation, but company charge only 60. Then you have to provide additional depreciation 40. Additional depreciation 40. Now let's see the adjustment. Let's see the adjustment. So additional depreciation reduces the property, plant and equipment value. So this additional depreciation, asset decreases, asset value decreases, and that goes to the expenses. Expenses increases. Asset value decreases, expenses increases. Asset value decreases, expenses increases. Now to increase this negative value, now you see expenses are in negative value. You say again minus 40. Now you see expenses are given in negative value. Then to increase the expense value, then you say minus 40. Then expenses increases, asset value decreases. Then how much adjustment to the asset value? How much adjustment to the asset value? You see total adjustment to the asset value. Total adjustment to the asset value increases by 800, decreases by 40. The total adjustment is 760. Increases by 760. Black property increases by 760. So black property increases by 760. Now you see adjustments, revaluation reserve increases, black property increases, expenses increases. So these are the three adjustments. Revaluation reserve increases, property value increases, expenses increases. Revaluation reserve increases by 800, property value increases by 760, and expenses increases by 40. Now you can do the adjustment in that Excel worksheet. You can do the adjustment. Expenses increases by, we are adjust in black. We are adjust in black. Expenses increases by 40. Property increases by 760. Then revaluation reserve increases by 800. So currently revaluation reserve is 0. That increases by 800. Right. So that's the adjustment for revaluation. Now after the adjustment, both companies have the same accounting policy. Earlier, Black was following cost model, Brown is following revaluation model. Now you see accounting policies were different. So with that, you can't compare two companies. You can't compare two companies. To compare two companies, you should see same accounting policies. You should see same accounting policies. Now we have adjusted Black for revaluation. The Black financial statements were adjusted for revaluation. Then now both companies, you see property at revaluation. Now property values of both companies are comparable. Right. Next, we'll see, you see the question. Number 3. Additional information number 3. You see Brown purchased new plant for 600 million on 1st January 2021. In line with the company policy, full depreciation at 20% has been charged on all plant owned at the year end. Now you see Brown accounting policy is full depreciation in the year of purchase. Now you see company purchase new plant on 1st January 2021. Year end 31st March 2021. Then only 3 months after purchasing the asset, company has used only 3 months. You see purchase on 1st January, financial year in 31st March. So company has used only for 3 months. But company's depreciation policy is charge full year depreciation. So actually company has used this asset for 3 months. But company charge full year depreciation. So this is not according to LK 16. Now you see, with this policy, depreciation has been overstated. You see again, company has used this new asset only for 3 months. But company has charged full year depreciation. Now you see with this, company's depreciation expense has been overstated. Therefore, profit has been understated. Profit has been understated. Now you have to do the adjustment. So this is a depreciation, over provision for depreciation. This is over provision for depreciation. Now how much over provision? how much over provision? So how much depreciation charged by the company? How much depreciation charged by the company? 600 multiplied by 20%. So company has charged depreciation 120. Company has charged depreciation 120. Full year depreciation. But out of this, only 3 months relevant for this year. Because company has used the new asset only for 3 months. Therefore, 9 months depreciation is over provision. So company has charged for over provision for depreciation is 9 months. So you can divide this by 12 multiplied by 9. You can calculate over provision for depreciation 90. Over provision for depreciation 90. So you have to adjust Brown. You have to adjust Brown. So in the Brown account, plant depreciation has been over provided. Plant depreciation has been over provided by 90. Then what is the adjustment? Then depreciation is over provided. Asset value understated. When depreciation is over provided, asset value has been understated. Therefore, asset value has to be increased by 90. Brown plant value has to be increased by 90. Then this 90, you have to deduct from operating expenses. So to deduct this, you can say plus 90. Because operating expenses are in negative value. To deduct the operating expenses, you can say plus 90. Now adjustment is plant value increases by 90. Operating expenses decreases by 90. Right. Now you can adjust in your worksheet. You can adjust in your worksheet. So plant value increases by 90. Right. Plant value increased by 90. Then operating expenses decreases by 90. Right. Operating expenses decrease by 90. Right. Then let's see Next one. Now, you see in the same additional information, now we have adjusted depreciation. Now you see with the depreciation policies, depreciation rates are same. Now you are going to compare two companies. Then both companies should have a depreciation same depreciation rates. Or both companies should have used same useful life for depreciating assets. Now you see Brown follows rate 20%. You see Brown follows 20% rate. Brown follows 20% rate. That means useful life 5 years. Black also follows the same. Black also follows the same. Now you see depreciation rates or useful life are same. Then two companies are comparable. Two companies are comparable. Then the last one, number 4. Additional information number 4. So this is about inventory. This is about inventory. You see black follows FIFO method. Brown follows, black follows LIFO. Brown follows FIFO. Now you see two companies' inventory costing methods are not the same. Therefore, two companies' inventory values, cost of sales values, therefore gross profit values are not comparable. So we studied inventory costing affects inventory values, cost of sales, gross profit. Now you see inventory costing methods are not the same. Two companies are not following same inventory costing. Therefore, these two companies' inventory values, cost of sales values, gross profit values are not comparable. Now you have to do the relevant adjustment. You have to do relevant adjustment. You see, price changes of inventory items during the year are on average 10%. So from beginning to the end of the year, inventory prices change by 10%. Inventory prices were changed by 10%. Okay. Now let's see first black. You see black follows LIFO. Black follows LIFO. So we studied if it is LIFO, cost of sales at current price, the problem with the inventory value. If it is LIFO, we studied cost of sales at current price, the problem with the closing stock value. Closing stock value. So the black company closing stock value at old price. Black company closing stock value at old price. So you have to bring that to a current price. You have to bring that into current price. Right. Now how we are going to adjust? How we are going to adjust? So black inventory value at old price. You see black inventory value 540. You see a black inventory value 540. This is at old price. Old price. This is at old price. This is not at current price. Now, how we are going to adjust? So, what's your idea? If you do not think, you don't get anything. So, remember, these are not like double entries. You find different situations. These are just examples. Examples of situation you have to adjust your account. These are just examples of situations you have to adjust your account. Now you have to see company's inventory holding period. Now if company holds inventory, let's say holding period through 2 months, after every 2 months, company purchase new stocks. After every 2 months, old stock go out and new stocks in the warehouse. So if the company's inventory holding period for 2 months, after every 2 months, old stocks has gone out, new are in the warehouse. Then the price changes, you have to adjust only for 2 months. Price changes, you need to adjust only for 2 months. Now let's see this company inventory holding period. You can calculate inventory holding period. You have cost of sales. You have black company cost of sales. You have black company inventory. You can calculate roughly a company's inventory holding period. Now let's calculate inventory turnover, cost of sales divided by inventory, then 365 divided by turnover. Now calculate how many days inventory holding period. So how many days of inventory holding period? Black company, inventory holding period, 365 divided by cost of sales, 1960, 1940 divided by inventory, 540. So let's see inventory holding period. So it's around 100 days. It's 101.59. 101.59, let's say around, we need rough value. We need just a rough idea. 100 days. Roughly 100 days. 100 days. Then you see, every 100 days after, old stock have gone out, new are in the warehouse. After every 100 days, old have gone out, old stocks have gone out, new are in the warehouse. Then you have to adjust price changes only for 100 days. Now, how much inventory value? Black inventory value. Black inventory at the year end. Year end inventory 540 has given 540. Then you adjust adjustment for current prices. Adjustment for current price. Adjustment for current price. 540 multiplied by 10%. You see price changes 10% for the entire year. You adjust for 100 days. Multiplied by 100 divided by 365. So price changes you adjust for 100 days. Because after every 100 days, all stocks have gone out, new are in the warehouse. Then how much? Adjustment. Adjustment is 14.7. You can say 15. Adjustment for current price is 15. Then inventory value after adjustment. Inventory value after adjustment 540 plus 15, 555. So adjustment is 15. Adjustment is 15. Right. Now you have to adjust black inventory. You have to adjust black inventory by 15. So black inventory increases by 15. Then black inventory is at current price. Black inventory is at current price. Right. So we have adjusted for black. Black cost of sales is okay because it's on LIFO basis. This is at current price. That's okay. So black inventory was at old price. Now we have done price adjustment. We have done price adjustment. So it's 15. Then how about brown? Brown follows FIFO method. You see brown follows FIFO method. You can remember in FIFO method, closing stock value is okay because it's at current price. So closing stock value is okay. Brown closing stock value is okay because it's at current price. The problem with the cost of sales. Problem with the cost of sales. So we know where the problem is under cost of sales. The problem is with opening stock. Problem is with opening stock. Because opening stock is at last year price. This opening stock is at last year price. So last year price is lower than the current year price. You see prices increases by 10%. So last year price is 10% lower than current year price. Now how much adjustment? This is at last year price. So last year price 10% lower than current year price. Now you have to adjust that price change. So how much lower? How much lower? 720. 720 multiplied by 10%. The price adjustment is 72. So this 720 at last year price, during the year prices increases by 10%. Therefore, last year price 10% lower than current year price. So price adjustment is 72. Then opening stock value, you need to increase by 72. Then what happens is cost of sales increases by 72. When opening stock value increases, cost of sales increases by 72. Right. Now these are the adjustments. For inventory, in brown, opening stock increases by 72. In black, closing stock increases by 50. Closing stock increases by 50. I will do the adjustments. You can do the adjustment in a Excel worksheet. So black closing stock increases by 15. Brown opening stock increases by 72. Right. Now we have done all the adjustments. We have completed all the adjustments. Now you can take adjusted values. Values as given plus adjustments. You can get adjusted values. Values as given plus adjustments. Right. Values as given plus adjustments. Right. Now gross profit. So we'll see black company. Sales increases by 75. Cost of sales, there is no adjustment. Then gross profit, you can calculate sales minus cost of sales. Sales minus cost of sales. Then operating expenses increases by 40. Then that comes to 520. There's no changes to interest expense. Then profit for the year. Gross profit minus those expenses. Gross profit minus those expenses. Now you see revised profit 535. Now here we don't have taxes. Now if we had taxes, we should adjust taxes. Now to simplify, I have not taken taxes here. Now you see Profit has given 500. You see a profit has given 500. But a revised profit 535. The meaning is profit increases by 35. The final profit increases by 35. You see, profit has given 500. Revised profit is 535. Now you see with the adjustments, profit increases by 35. So how this 35 comes? Sales increases by 75. Expenses increases by 40. The net effect is 35. Net effect is profit increases by 35. Then what happens? Retained earnings increases by 35. So that comes to the retained earnings. So if profit increases by 35, so that effect will come to the retained earnings. That effect will come to the retained earnings. So retained earnings increases by 35. Right. Now let's see the assets. Property value increases by 760. Plant value, there's no change. Inventory value increases by 15. Debtors value increases by 75. Bank balance, there's no change. There's no change. Then total assets. You can calculate total assets. Total assets. Then equity shares, there's no change. But revaluation reserve increases by 800. Retained earnings increases by 35. Other things are same. Other things are same. There are no changes. Then total equity and liabilities. Total equity and liabilities. Now you see here total assets is not equal to equity and liabilities. That doesn't matter. Because we have not done double entries. We have not adjusted by using double entries. Now what we did was we simply adjusted the relevant values to make them suitable for the analysis. We have not passed double entries. Therefore, these total assets will not be equal to equity and liabilities. So you don't need to worry about this. So our purpose is to make the financial statements suitable for the analysis. So we have not passed any double entries. Therefore, your total assets will not be equal to equity and liability. Right. So similarly, you can see the Brown company. Brown company. Sales, there's no adjustment. Sales, there's no adjustment. Opening stock value increases by 72. Purchases, closing stock, there is no adjustment. Then cost of sales change. Cost of sales change. How much? Revised cost of sales. Opening stock plus purchases minus closing stock. Revised cost of sales, 3022. Revised cost of sales, 3022. Then gross profit, sales minus cost of sales. You have gross profit. Gross profit. Expenses decreases by 90. Expenses decreases by 90. Then 872. Then there's no change in the interest expense. You see the profit for the year. Profit for the year, 494. You see profit for the year, 494. Earlier profit, 476. Now profit increases by how much? Profit increases by 18. You see profit increases by 18. Profit increases by 18. Then you have to increase the retained earnings by 18. You have to increase your retained earnings by 18. Retained earnings increases by 18. Right. Now let's see the assets, brown assets. There's no changes to property, but the plant value increases by 90. Other assets values are same. Other asset values are same. Then total assets. Total assets. 4,790. Total assets, 4,790. Then equity and liabilities. So retained earnings increases by 18. And other items are same. Other values are same. Then total equity and liabilities. $4,780. Right. So you don't need to worry about this. Total assets is not equal to equity and liabilities because we have not passed any double entry. We adjusted our financial statement to make them suitable for the analysis. The differences in two companies we have adjusted. Now you see after the adjustment, two companies have same accounting policies. And we have adjusted for LIFO, FIFO differences. In LIFO method, in stock value is not at current cost. Then we have adjusted. In FIFO method, In FIFO method, cost of sales are not at current cost. Then we have increased the cost of sales. We have increased the cost of sales. So all these adjustments to make the financial statement suitable for the analysis. So we haven't passed any double entries. We haven't passed any double entries. So this is what you have to understand. Right. Now our financial statements are suitable for the analysis. So you can do ratio analysis, common size analysis, trend analysis. Now here we can do common size analysis. We can do ratio analysis. Right. So we can analyze ROA. We can analyze ROE. So by doing these analyses, you select the company to invest. So that's your homework. Now we have done the accounting analysis. You can do now financial analysis. Then select the company to invest. So this is how you have to do the analysis. First, make the financial statement suitable for the analysis. So you have to do the accounting analysis. After the accounting analysis, you have financial statements that are suitable to do the analysis. Then you can start your financial analysis. Right. So this is practically how you do the analysis. Yes, you have to do the ratio analysis using adjusted values. Now, after the accounting analysis, you don't look at these previous values. All the analyses based on these adjusted values. All your analyses are based on these adjusted values. Otherwise, there is no point of doing the accounting analysis. So hereafter, you are going for these adjusted values, because these are the values suitable to do the analysis. These are the values suitable for the analysis. Right. So this is how practically you start the analysis. Right. So you should know these practical aspects, because during the industrial training, when you are working in a company, right? So these are very helpful. Right. So I see only the participation 64. So it's less than 50% of our class. Right. So others will not get these points. So they will realize the importance of learning this when they are working after the graduation. When they are working, they will realize the importance of this. Right. So it's up to them. Right. Because practically, it's very difficult to do analysis. It's not easy thing. There are a lot of things you have to do before the analysis. So if you know at least some of these during this or by learning this subject, that will really helpful in your career. Because you don't prepare for account, just bookkeeping jobs. You know, now the role of the accountant has significantly changed. You are a part of the decision-making team in the company. You are a part of the decision-making body of the company. Then every time you have to do some analysis and support the decision-making. Right. So your job is not keeping accounts, recording transactions. So your job is to contribute the company's decision making. So every time you do some analysis and support company's decision making. So this knowledge will really help you. Right. So now we have completed part 1 of accounting analysis of investing activities. So next time we'll do analysis of financing activities. Then after that we'll do a similar tutorial. So we'll see how the things are done. Right. Any questions to us? You should apply these into your selected company. For example, when you compare 5 years, you find some accounting policies have changed. When you compare 5 years, you find company has changed accounting policies. Then you can't compare 5 years. You can compare 5 years only if the company follows the same accounting policies. So if there are changes, you should try to do some adjustments. Then you can try LIFO, FIFO adjustments, right? You can try many of these. But you get to know about that only if you have thoroughly studied the company. That's why I have given you 3 weeks to study the company. So you will get to know about the accounting adjustments before the analysis. You will get to know about the accounting adjustments only if you have thoroughly studied the company. Otherwise, you will not know. Right. That's why I'm telling you from your assignments, I can find those who have studied the company thoroughly and those who are not, who have not. So those who have studied the company thoroughly, they will get to know about the accounting adjustments. So they will score higher marks. Others, so I don't know, right? I can find from your assignments. Right. So we'll study more about this. Right. Any questions to ask? Any questions? Right. Then see you next time.
Thank you, sir.
You're welcome.
Thank you, sir.
Thank you, sir.
You're welcome.